This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money Markets podcast. I'm Dan Coatsworth and joining me is Danni Hewson. Hi there, Danni.
Hi, Dan.
Now, we're only a few days away from Christmas, but there's still plenty to talk about. So we'll shortly be discussing some interesting figures on the supermarket sector and look at how the cost of Christmas dinner has gone up.
Coffee and chocolate have certainly become more expensive this year, and we've got some interesting takes involving these products.
So the FTSE 100 index is going through a little bit of change with a few new members. Another is set to leave, and a new name, which is actually big enough to join, won't be given an admission ticket. So stay tuned to find out more.
The car finance scandal keeps getting bigger, and the regulator has now said it could be on the scale of PPI, which cost banks £50 billion. Dan's going to be taking a look at that topic later on in the pod, while I'm going to chat about the cost of renting a property in the UK.
We've got three guests on the podcast this week. Farmbrough and Ben Needham from NinetyOne UK Equity Income Fund will be here to talk about Wetherspoons, Diageo and more. We'll also hear from Impax Environmental Markets about the potential change to green policies under Donald Trump. But first up, let's dive into that Christmas content. So, Danni, shall we start with the latest on the supermarkets? How are they faring?
Have you been into a supermarket in the last couple of weeks, Dan?
No, I haven't, no.
Because that'll give you an indication of how they are faring. We've got a Marks and Spencer Simply Food and an Aldi and a Pets at Home and a couple of other stores near us with a teeny tiny car park. And I have to say, in the run up to Christmas, you always know that that is one retail park to avoid because you cannot find a parking space for love nor money. And that just gives an indication of how the consumer feels about Christmas, but also particularly about this Christmas. And we had some really interesting figures out from Kantar just a couple of days ago. And it suggested that this year Brits are likely to splash out a record £13 billion over those crucial 4 Christmas weeks. I mean, that is a record amount that the supermarkets are expecting to have come through their tills. Now, I don't think anyone will be surprised to learn that at the moment, Kantar reckons that Marks and Spencer's is winning out. A third of us are shopping at Marks and Spencer's. I mean, they're always brilliant at the Christmas advertising campaign. They're really clever at reimagining an old favourite and kind of putting that gloss on it, which really makes you want to pop in and taste it. And then when you get in there, chances are you pick up a basket and you end up coming out with a trolley full. That is what they are attempting to do. But of course, a lot of us are also still thinking about cash. We are still looking for own brand stuff. And that's where some of the other supermarkets, particularly Sainsbury's and Tesco, are doing very well indeed. In fact, Britain's largest grocer has achieved its highest market share since 2017 at 28.1%, which is an absolutely huge amount when you think about it. Sainsbury's share has also gone up a bit, 0.3 percentage points to 15.9%, which means that the UK's top 2 grocers now have a combined market share of 44%, which is really interesting because we've been talking really since the end of the pandemic about that renewed march of the discounters, Aldi and Lidl. They are still grabbing bits of the market, but it does seem that they have managed to take that from places like Asda and Morrison's, and certainly Asda not only is looking for a new CEO, but has brought in an old CEO to be the new chairman there. So really concentrating on trying to get back to the future. That was the message from them. But yeah, I mean, another thing which I sort of looked at in these figures, which is really interesting, is the use of promotions. We know when we are thinking about how far our cash is going to stretch, and, you know, Christmas is a costly time of year, we know that we want to find the best deals. And what Kantar have also found is that sales on promotion reached 30% in November. That's the highest since Christmas last year. So I guess it does depend on whether or not those offers and promotions continue over this Christmas period. And then, of course, what happens to the cost of our shop post those promotions, just at a time when energy bills go up a little bit as well. So a lot of people might get a bit of a shock when they shop after Christmas. But even with all of that, I mean, those promotions, they're offsetting the cost of a Christmas dinner, but it's still going up.
Yeah, I mean, we're looking at an average £32.57 per person, based on a meal for four for your Christmas dinner this year. So turkey is one of the key things that is shot up in price, and actually vegetables are getting more expensive too. So if you sort of take a step back, the 6.5% rise in the cost this year for your Christmas dinner, it's actually more than twice the rate of overall grocery inflation, which was 2.6% at the latest reading. So that you mentioned about Marks and Spencer's, it seems tipped as being one of the sort of the winners this year for Christmas. I think they would love to get you doing your weekly shop in their stores, but something about Christmas that people always treat themselves by going into their stores. So, say Tesco and Sainsbury's, they're probably expecting good demand for a premium range. But it's really interesting. Shoppers seem to be sort of spreading out their Christmas spending by doing a little bit each week rather than buying everything at last minute. So Kantar did note that during November, there was sort of an uptick in the type of products that we might enjoy over the festive seasons, like assorted sweet biscuits and biscuits for cheese. Interestingly, 8% of shoppers even bought Christmas pudding in November. I certainly was not one of them. I can't stand it.
Do you not like Christmas pudding?
Absolutely not, no.
Oh, I love Christmas pudding, but I am the only one in the family that does. So I have to get one of those little individual ones, and everyone else has some kind of chocolate fudge cake or something. But yes, no, I absolutely love Christmas pudding. But it's really interesting that Kantar had found, and you were mentioning there, that people started shopping for things like biscuits in November. Because a couple of years ago, when the cost of living crisis was really acute, I think it was the British Retail Consortium that was saying that a lot of shoppers were sort of starting that back in October because they were just trying to spread the cost. So I think consumers do seem to be feeling a little better about their spend. But I wonder how much of that is because they're spending less on gifts. And certainly we've had an update from Vinted talking about the fact that people are now spending more on pre-loved stuff, which sometimes comes with less of a price tag, unless you've got teenage daughters like I've got who suddenly find that they really, 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 really want expensive designer stuff. But the one thing that I am really pleased about is I don't drink coffee. You're not a coffee drinker either, are you?
I've gone back to it actually recently.
Have you?
Yeah, I mean, I was off it for ages, but this is very much a year I've rediscovered it. Of course, I've done it at the wrong time, haven't I? It's getting a little bit expensive.
It is getting expensive, and unfortunately, it looks like it's going to get more expensive. So we just had earlier this week the price for Arabica beans jumping to a record amount, hit $3.44 a pound. That's 80% up this year. And we've also, so Arabica beans are the ones that you get in posh coffees. Robusta beans tend to be the ones that you get in instant coffee. And they, unfortunately, have also hit a fresh record high in September. Now, it's a sort of double-edged issue because on the one hand, you've got concerns about the crops, particularly in Brazil and Vietnam. They've been hit by bad weather, and there's a lot of worry that maybe the crop that is planted now won't flower, and then things will get even worse. But you've also got a situation where people are drinking a lot more coffee. So you've gone back to it. I'm a tea drinker, and I certainly seem to be in the minority. In fact, we had some numbers out from Mintel suggesting that tea drinking in the UK has gone down significantly. But another thing which we have seen in a lot of those big names, brands like Dow Egberts, Nestle, who have the kind of coffee that we have on our shelves, They have been saying that over the past couple of years, they've tried their absolute hardest not to pass on the higher raw material costs to customers, but that soaring prices have eventually forced their hands. And a lot are now thinking that they might have to implement a price increase in supermarkets in the first quarter of 2025. So if you're already going into a supermarket and thinking, hang on, that's expensive, unfortunately, it might just get even more expensive.
I know. I think you could probably add chocolate to your list as well. So we obviously got, recently cocoa prices have been soaring as well. Whilst they've sort of come down a little bit from their peaks, they do remain quite elevated compared to previous years. And of course, this is not good for chocolate manufacturers. Sugar costs have also been pretty high. And of course, when you have companies that are hit by really big increases in costs, you start to think, okay, well, can they survive on their own? Are we going to see a sort of consolidation in the industry? And this is kind of, the alarm bells have been triggered this week in sort of the chocolate industry, where there's speculation that Cadbury's owner Mondelez is looking to potentially buy US chocolate maker Hershey. That would be a pretty big deal, because we've got, if you go back to 2016, that there was, Mondelez did look at doing such a deal. It walked away from those discussions. But now it kind of, you've got a packaged food industry dealing with sort of falling volumes, a weakening sort of global consumer. Companies are trying to sort of do well in this industry, but equally we've got the average person is trying to be a bit more health conscious. So as we're recording this, there's not a firm deal, but you can kind of see why it might make sense, because Mondelez owns Cadbury's, it owns Ritz crackers, Philadelphia Spread, Sour Patch Kids sweets. So it's got a broad sort of snacking portfolio. Essentially, if it bought Hershey's, it would give it more buying power in the cocoa market, and obviously that would help to deal with price pressures a bit more effectively. So definitely one to keep your eye on.
Now, Dan, it's not very often that a story about markets and potential mergers catches the attention of the household here. However, my eldest daughter, when I started telling her about this, she just absolutely lost it. She loves Cadbury chocolate. She absolutely hates Hershey's chocolate. And the idea that they might even touch each other somehow in the production facilities, she wasn't happy.
Well, it's true, because if you look on social media, I see quite a lot of videos these days of Americans coming to Britain and saying, "Oh my God, your chocolate's amazing!" I sort of loading up on all this stuff, and you're thinking, okay, yeah, it's definitely something for UK chocolate, something we should be proud of, and ultimately Hershey's has got I don't know. It just tastes cheap, doesn't it? It's cheap and nasty. So
dishwater, yeah. I think, yeah.
Should we talk about what's going on in the UK stock market? We've got quite a lot of activity involving the FTSE 100 index.
We have. And I know that you're going to be talking a little bit about the reshuffles that have been happening, but I just wanted to pick up about one newcomer to the FTSE, but not the FTSE 100. So this is Canal, which is the French TV company. You know it. If you've seen any of the Paddington films, Total Recall, Back to Black, this is a massive global media company. And it is going to debut its shares on the London Stock Exchange on Monday after getting approval of the shareholders of its owner, Vivendi. Now, it's interesting because Vivendi is effectively splitting out its three main subsidiaries. So you've got Canal+, you've got the communication group Havas, and its publishing division, Louis Hachette Group. They're going to list in different places. So Canal+ in London, Havas in Amsterdam, and Louis Hachette in Paris. So it kind of spreads the whole investment across Europe. But people might be wondering, because Canal+ is massive. So why, given the size of the company, will it not qualify for the FTSE 100? And it's not down to the size, it's down literally to a technicality. So it has said, I think it was you that spotted in the IPO prospectus that it will not adhere to the UK takeover code. And because it says that it won't adhere to that, it means that it won't actually qualify for the FTSE indices. So although it joins the London Stock Exchange, it could take some time before such a huge UK listed player is actually joining the ranks of, say, the FTSE 100, if ever.
I think it's quite frustrating. It's got an exciting name to join in the market, and equally, like you say, that the size, it's just been a bit stubborn, isn't it? I don't know why list in the UK and sort of not have this great opportunity to be in the FTSE 100. It's a real badge of honor. Every quarter we get a sort of a reshuffle. Things the sort of that the index provider will look to see which companies have moved up and down in value, and essentially moves sort of the decks around a bit. And there's always a bit of excitement about, okay, who's staying in, anyone's going to be promoted. So we've just had this reshuffle, and we've got names like Games Workshop are making their debut in the FTSE 100. The Alliance Witten Investment Trust that's merged together, that's in as well. Things like Frasers and B&M are being kicked out. So all this is quite exciting. So yeah, it's a shame about Canal Plus. But actually, just one quick thing while we're on this topic. Ashtead is a construction equipment rental group. It's been in the FTSE 100 for as long as I can remember. It's come out and said in the next 12 to 18 months, it's going to shift its main stock market listing to America. It does nearly all of its business there. Management are based there. And it's essentially saying, well, it just makes perfect sense for us to sort of focus on the US. So that will automatically, leave the FTSE 100 as soon as it shifts its main stock market listing to America. A bit of a drama about this. There's lots of headlines saying, this is the end of the UK stock market. Everyone's, upping sticks going to America. It's probably worth pointing out, if you just look at the big companies that are doing this, you can count them on one hand. It's Paddy Power owner Flutter, CRH in Divior, and going back a bit, the old Wolseley business, now known as Ferguson. So I don't think there's reason to panic. Obviously, it's not good when you do see the shift here, but I think the UK stock market is still looking fine, still interesting. We had some changes to the listing rules in July, which could lead to more IPOs from next year. So I think we'll have lots to talk about on the podcast in the coming months, hopefully for new names. And I know that investors do like it when we get new names. It's things to get excited about.
Right, before we bring on our first guest, let's move into the world of car finance, because a lot of drivers could be in line for compensation, Dan.
Yeah, I mean, we've perhaps touched on this a few times in the podcast, but it seems on a weekly basis something new happens. So I thought it'd be worth just sort of giving a quick summary of where things are, because if you haven't come across it before, you will almost certainly be hearing about this in the coming months. So if you go back to January, the regulator, the Financial Conduct Authority, launched an investigation into discretionary commission arrangements on car loans that happened between 2007 and 2021. The practice meant that car dealerships and brokers had the power to set interest rates on car loans and earned higher commission along the way. So this was essentially banned by the FCA in 2021 about concerns that they were incentivizing dealers to charge high interest rates. So we were meant to get a decision from the watchdog in September, but that got pushed to next May because all the lenders were struggling to sort of provide data in time. Because we had that delay, it actually gave time for a judge to look at a test case against specialist lenders Close Brothers and First Rand Bank. So if you go to October this year, a Court of Appeal ruled on this test case and upheld a decision that it was unlawful for two lenders to pay a secret commission to car dealers without borrowers' knowledge. So essentially that meant that the judgment went beyond the FCA investigation into just discretionary commission arrangements. So I know it's a bit complicated, but I'm almost there. Judges said consumers needed to know all the material facts that could affect their borrowing decision, including the total commission to car dealers and how it was calculated in order to be able to consent to the loan. Now, some lawyers have speculated that consumers could potentially get, well, collectively, billions of pounds in compensation, and in some cases have their car loan written off or rescinded. So it could also spark complaints and payouts about other types of commission payments related to motor finance and potentially to other loans and financial products. So we've had the General Counsel, Executive Director from the FCA, Stephen Bravanel-Romans, come out and said that this car finance scandal could end up being as big as the PPI mis-selling scandal, which cost banks £50 billion. And of course, this has sort of pricked up the ears of, these so-called ambulance chasers, so claims management firms. Now, if you go back to the PPI sort of scandal between 2011 and 2019, these sort of ambulance chaser companies made estimated £4 to £5 billion in the process, according to the National Audit Office. It does look like we might get a repeat of the situation. So these firms filing large amounts of claims, hoping to collect fees that could be as much as 50% on winning cases. So I would say, watch out. I imagine social media is going to be blasted by adverts from these companies saying, we'll help you file for compensation to do with car finance. It is getting really, really big. And I think definitely one to watch here.
Yeah, I'm definitely going to try and look back through some old paperwork and find details of my car finance. And I would imagine quite a lot of people are thinking the same. Before we have our first guest, I'm just going to bring a bit of breaking news as we're recording this on Wednesday. We've just had the latest US consumer prices up by the largest gain since April, up by 0.3% over the month. So it's climbing to 2.7%. We'll talk more about inflation and interest rates in next week's episode of the pod. But first, let's bring on our first guests. Anna Farmbrough and Ben Needham are co-portfolio managers of the NinetyOne UK Equity Income. And Dan recently caught up with them via Zoom to talk about big brand companies, drinks producers, and cigarette makers. Let's hear what they had to say.
I think that I'd like to just ask you, start the conversation off just talking about what sort of investors look for these days with equity income funds. Because I think historically people have put money into them principally to receive a steady stream of dividends. Obviously, that makes them really popular with people in retirement. But I think nowadays people expect their investments to keep growing in retirement. So I was wondering if that sort of put pressure on you to try to and achieve sort of a sizable chunk of your returns from capital growth as well as income. And if that is the case, I mean, how much risk are you comfortable taking?
Yeah, that's a good question, Dan. So I actually grew up on a family farm, and I'm still involved in the business today, albeit my father he very much runs the show. I say that as I think that real world experience, if you like, has hugely shaped my perception of risk, and is a good way to actually answer this question. So let's dissect a farming business or a farming business for a second. So to grow revenues, you either need more volume or higher prices. To grow volumes, you either buy a new farm and or you try to improve your crop yield. A crop science has limits, meaning improving your yield is very hard, whilst buying new farms are expensive. So you need a lot of capital to do that. So it's very hard to grow your volumes. Then running the business is tough. You have to upfront investment each year. You have to buy all the seed and fertilizer and pesticides. You have to get it in the ground and on the crop at the right time. And then you have to harvest the crop at the right time. Then two things can blow you up, including bad weather and or falling commodity prices. So you can do a really good job operationally, but the exogenous drivers can destroy your year. And that means typically, 3 out of 10, 4 out of 10 years, you can actually lose money and not make a return on capital at all, which is very typical of a farming business. And then furthermore, when and if you actually do make a profit, turning that into cash flow is not always the case, because you have to reinvest in machinery, because it's a very capital intensive business to be in. So if we take all that together, it's hard to grow volumes. It's hard to operationally grow a crop. Once you have the crop, a low commodity price and or bad weather can blow your kneecaps off. And any profit you might have might not equate to cash flow. So that means the dollar profit or cash flow that a farm makes today can be very similar to what it made, say, 10 to 15 years ago. So we try and look for the opposite. as investors. We try and find businesses with high barriers to entry, but the ones which are pretty capital light and less dependent on exogenous events to drive a growing profit and free cash flow stream. We like businesses with predictable and growing revenue and income streams, which are quite different to the family farm. And
if on the sort of subject to what companies are up to at the moment, if you read the headlines, you're hearing a lot of companies in the UK not too happy about the impact of the budget on their cost base. The increase in employer national insurance, the minimum wage, changes to employment rights, all these things that sort of could pushes up their costs, and that they might actually have to think, well, do they pass that cost on to the customer? Do you I'm just looking at you've got stakes in Reckitt and Unilever in your portfolio. I'm just wondering, do you think that if we get these sort of big, expensive branded product providers pushing up prices yet again, do you think the customers will sort of just turn their backs on these types of companies and look for the cheaper stuff?
It's definitely something we think about, but we think these brands have enough strength that they have pretty low price elasticity. And we've seen this before, at the end of 2022, beginning of 2023, when prices were rising significantly. These business models were tested, but actually their gross profits, which is a good measure of, what the extent to which they could pass through cost increases in pricing, their gross profits were pretty resilient. So that's a great starting point. And many of the products that Unilever and Reckitt sell are quite low ticket, repeat purchases. We worry far more about high value, high ticket items. So a new house purchase or a new kitchen, we think those are far more likely to come under pressure. But I have a cold this week. When I went into Boots this morning, I reached straight for the Lemsip, which is a Reckitt's product. I know that I could buy pretty much the same product manufactured by Boots, and it would probably be half the price, but I still find myself reaching for the Lemsip. And that's the beauty of those business models. But at a portfolio level, we think about balancing some of those more premium products with very strong brand power with other businesses which maybe customers might trade down to. So another business we own is Wetherspoons, the pub company. And Wetherspoons reinvest into price year in, year out. So they try and widen the gap of the prices that they charge relative to other pub companies. And before the pandemic, they used to charge probably 20% less for the average pint than other pubs around the corner. And then after the pandemic, when all of the pub companies were having to raise prices to, recover all their higher costs, Wetherspoons widened that gap even more. So they really held on to pricing. And I think the gap now between Wetherspoons and a typical competitor pub is more like 40%. A glass of wine at my local Wetherspoons is £1.60. And if that goes up by 10%, it's going to go up by 8p. And it will be less than £1.70 still. But at the gastropub, the nearest gastropub, a glass of wine is more like £8. If that goes up to £9, I'm more likely to think twice. And I might think, actually, I'll just go to Wetherspoons around the corner. And as it happens, when I moved to the area 6 years ago, there were 3 pubs on that corner. There's now only one, and that's Wetherspoons. So you've seen supply come out of that sector as costs have increased so much over the last few years. But we actually think Wetherspoons should benefit from trading down because they've been so disciplined on not raising prices too far. And we think businesses like Wetherspoons, balanced with businesses like Unilever, like Reckitt, provides a real balance through the portfolio because we can't predict how consumers are going to behave and where they're going to spend their money.
Just sticking with the topic of alcohol, obviously you've got your largest position in your fund is Diageo. So obviously that's Guinness, but also lots of different spirits as well. So I guess it's sort of aimed at sort of different types of customer base. Its share price actually has not done very well. Lots of a few problems over the last couple of years affecting the company. It's now on the highest 12-month forward dividend yield since 2011 at 3.6%. So I was just having a look back, and the data implies you should really historically would have expected around 2.5-3% yield. So normally when we see the sharp increase in dividend yield, it can be a red flag precursor to a dividend cut. Do you think that might actually be on the cards for Diageo?
We say anything is possible, but we think it's very unlikely. Dan. So Diageo is a very diversified business by brand and geography, and that helps the ultimate defensiveness of the revenue and free cash flow stream. It's interesting studying the business in the great financial crisis in 2009, 2010. The majority or bias of their revenues and profitability is in the US spirits industry, and actually volumes did not shrink in 2002 and 2009, 2010, despite all of the pressure that the customer was under in those years. So that gives us optimism that if there was economic weakness in the next few years, that their revenue and free cash flow stream can be and should be defensive, and that ultimately is important for the dividend sustainability as we look forward to. And then importantly, the business is very well invested. So if you look at the advertising and promotion spend, it's increased as a percentage of sales every single year. They very much reinvest in their manufacturing capability to make themselves more self-sufficient and use renewable energy as an input to their distilleries, as opposed to hydrocarbons, which is something we applaud and very much advocate as active holders of the company. And they also have a lot of aged inventory, which they continue to invest in. So again, if there was a severe downturn, these are all levers that they could use to help generate more cash, because they don't necessarily need to be investing as heavily as what they are. So we feel pretty confident that the dividend is sustainable. It's cash backed, and the stock's very interesting currently.
The other thing we think is quite interesting about the drinking sector at the moment is that the narrative is very negative. And because you've seen lower volumes with weaker consumer sentiment and some destocking, there's a sort of a prevailing narrative at the moment that people are never going to drink as much as they used to. And we think actually, when you survey people on how much they drink, people always say they drink less than they actually do. And the spend data is quite interesting because Gen Z talks about drinking far less and being far more health conscious, but actually the spend data shows that Gen Z spends just as much on alcohol as previous generations. And the other narrative that's quite interesting is that people are saying with GLP-1s that people are going to drink less because the appetite is so suppressed, and that GLP-1s are really taking off in America, for instance. But actually 80% of people who take GLP-1s are female, and women only account for 20% of alcohol consumption in the US. So we don't think you're seeing a big impact on alcohol consumption.
So the GLP-1 is for those listening who are listening, that's weight loss drugs, isn't it? So that
exactly, yeah. And they suppress your appetite, and they also suppress the enjoyment of something like alcohol.
Yeah. Okay. I mean, you've got stakes in British American Tobacco and Philip Morris, the cigarette manufacturers. I mean, that industry has proved to be a lot more resilient than perhaps some people expected. I mean, there's certainly pressures from regulators, politicians, and people in society sort of trying to promote healthier lifestyles. Given that these pressures are ever growing, can you see a point where actually you'd no longer invest in that sort of industry, not because of moral reasons, but perhaps because of diminishing returns?
Yeah, it's worth actually noting that nicotine consumption globally, believe it or not, it's not actually shrinking. It's increasing. If you study a business in the US called Altria, they have some good charts on this. And the interesting thing as well about the industry is it does innovate. And Philip Morris is a great example of this. So 40% of Philip Morris's portfolio today is actually derived from next generation products, which are reduced risk for the customer in that they're smokeless products. So the two core products that they have, which account for 40% of revenues today and are growing very quickly, include IQOS, which is I Quit Original Smoking, which is a heat not burn product, where they have 80% market share. And then there's a product called Zyn, which is a nicotine pouch. Again, there's no combustion. It's a smokeless product, and it's very big in the Nordic countries and also growing very quickly in the US. And again, they have leading market share in that category, well over 60% market share. And the two interesting things about the next generation products, or the most interesting thing I think about the next generation products, is the attractive financial model that they have. So the revenue per unit and the gross profit per unit are actually accretive or higher than what the combustible units are. So it's actually very good for their financial model as these products grow quicker within the mix. And therefore, the financial model of Philip Morris is not diminishing, it's actually improving. So if you look at the 2024 numbers for Philip Morris, you can see that actually volumes are growing by 3%. They're also able to raise price, and profits are growing quicker than their revenues. And we think that kind of mix of growth, if you like, and financial algorithm is one that they're capable of doing on a medium-term basis.
Thanks again to Anna Farmbrough and Ben Needham for coming on the podcast.
Now, there's been a lot of chatter about the rising cost of rent in the UK, but it does seem like there could be a bit of good news on the horizon. So, Danny, what have you heard?
Yeah, potentially good news, because it looks like the rate of rental increases are slowing. But, I mean, the headline figures are pretty stark. So, according to Zoopla, the average cost of renting a newly let property has risen by £3,240 a year since the end of the string of COVID-19 lockdowns. So that's now an average rental cost of just over £15,000, up £270 a month since the end of the pandemic. And of course, a lot of this is down to the fact that people have maybe wanted to move a lot more. Maybe they have been wanting to move because they've been able to work from home, or because they wanted more from their home. And also, of course, we've had a situation where some people I know were hit by higher mortgage costs, decided that they were going to sell their home and rent until interest rates came down. So we've had real oversubscription in terms of the number of renters looking for property. Meanwhile, the number of rented homes hasn't actually grown since 2016. So that means that you've got this massive demand and supply which is not growing in order to meet that demand. Now, we know that rental growth has slowed, but there is still expected to be an ongoing lack of rental supply to keep up with that. So we are still expecting rents to go up, but maybe not by as much as we had before. And we know also that some private landlords have actually been selling off rental homes in recent years because of higher mortgage costs, although Zoopla said that it looks like the peak of private landlord sell-off has now passed. And actually, we could be at a point where some landlords are waiting to see when interest rates are lower, if they go down. We're hearing from the Bank of England maybe 3 cuts next year. Certainly that's market expectation at the moment. Then that could bring them back in to buy more homes. And of course, Labour has said that it wants to build more homes over the next 5 years. So, just as with the housing market in general, the rental market, it is still incredibly hot. And of course, for people who are wanting to get on the housing market, if rental prices are high, then it makes it even harder to save up for a deposit.
Well, brilliant. Thanks, Danny. So let's bring on our final guest. I think the election of Donald Trump is expected to signal a reverse of the green policies that were introduced by the Biden administration. So we sent Tom Sieber to meet up with Impax Environmental Markets co-manager Fotis Chatzimichalakis to find out what's going on. So let's hear that interview now.
Hi, Fotis. Thanks for joining us. I wanted to start this interview by talking about the election of Donald Trump, which obviously, as we speak, happened around a month ago. Could you explain what, if anything, that means for the trust and its investments?
Sure. Hi, Tom. Nice to be talking to you today. So what I would say is that, a Trump clean sweep was definitely not our base case, and that has made for some negative headlines in terms of its potential impact on environmental markets. But I would say if we start sort of looking what might the impact be on the various parts of our opportunity set, it's a lot more nuanced. So my one sentence summary would be that we have very modest exposure to the challenged areas. I mean, people often underappreciate how diverse is the opportunity set for IEM. Renewables is only 7% of the trust. So modest exposure to the challenged areas and higher exposure in areas that could emerge as Trump beneficiaries. So if we start looking at the various parts of the opportunity set, I would say we have relatively limited exposure in alternative energy, in renewables, and we have taken action to be more in areas like the project developers instead of the equipment manufacturers. And that's because we believe that in the project developer space, valuations are pretty a lot more interesting. Companies are trading below the value of existing operating assets. So, that is looking interesting to us. Then if you think about transportation, there is a headline risk with some of the EV tax credits being rolled back potentially. But, again, here we have pretty small exposure in the trust. And, if we see a slower EV penetration and policy momentum in the US, it could mean a stronger outlook for hybrids and internal combustion engines, where some of the companies we have are active in providing pollution control equipment for these types of vehicles. And then maybe the last area that's a bit more of a mixed bag is in sustainable food and agriculture, where there are some concerns that, as a result of the Trump election, we could see more tariffs and that could impact demand for agricultural equipment. But again, that's an area we don't have a lot of exposure. And, if anything, in this space, we've had the next, expected to be healthcare secretary, RFK in the US, being very vocal against processed food. And that would actually be a positive for the natural ingredient companies that we have in the trust. So there are some more mixed bag areas, but, where there's a lot more excitement, I would say, is that we have pretty high material exposure in sectors that could have a more positive growth outlook as a result of Trump. I mean, if you think about what is Trump about, he's very much about growth in the US, pro onshoring of manufacturing. So, material parts of the portfolio such as energy efficiency, water infrastructure, waste management, could definitely benefit as a result of these policies.
That's really interesting. I mean, from what you're saying, then it doesn't sound like you're going to have kind of a wholesale change of approach in terms of managing the trust. Is there an element, though, of kind of having to react a little bit because I guess Trump's agenda is perhaps a bit unpredictable, or certainly how it will be implemented?
Yeah, I would say, definitely agree with you that there's no wholesale change of approach. More incremental tweaks here and there. For example, what I mentioned before about our positioning in the renewable energy space in the project developers versus the equipment manufacturers. But yeah, it's really about changes here and there rather than wholesale changes. We still feel pretty good about the rest of the portfolio.
And looking kind of more globally, do you think what's happened in the US politically is reflective of a kind of wider shift? And are you seeing signs that perhaps some of the kind of environmental regulations and some of the environmental policies are being watered down?
Yeah, so I mean, I think we have to admit that there is a bit of a slowdown, but we have to see that slowdown in its broader context. We are coming from a very high base of targets that were set in a completely different macroeconomic environment, 4 or 5 years ago. So what we're seeing today is bringing these targets, these very ambitious targets, more in line with what's happening in the world today. So I would say, there is maybe a change in the gradient of the curve, but not so much a change in the end destination of where we're heading. I mean, something that's also important to appreciate, I would say 2 more things, that in the trust, a lot of the growth opportunities underpinned by existing policies that are already in place. So instead of, it's not about hoping that a massive new stimulus package will come in place or anything like that. And then also, it's very important to appreciate that a lot of our markets are just growing based on pure economics. It's not about regulations and policies. So, I would say there is a bit of a, bringing things in line with today's reality, but I wouldn't say that there's a, roll back and complete change of destination.
Sure, that makes sense. I mean, one thing that we saw, I suppose, when the first was a very much a kind of burgeoning of awareness in terms of ESG, particularly in terms of investing, was greenwashing. I wonder what you think about kind of the attempts perhaps to regulate that.
So yeah, I think I am, having been sort of doing this for more than 20 years, and having what I would sort of frame as a very authentic, well thought, nuanced sort of investment process, I think that's only positive. I mean, you might have sort of seen recently we have adopted the sustainability impact label, the SDR label, and again, I would say there's no change to our process or the objective of the trust. We're still all about finding the best investment opportunities in our markets, but it does reflect that this trust has a focus in investing in solution providers that address environmental challenges. And, that comes with also a significant positive benefit, positive impact. So yeah, that's how I would position that.
I've read that I think the trust has become a little bit more concentrated in terms of focusing on its best ideas. So I wonder whether you could just talk me through some of the sort of areas you're seeing the best opportunities and perhaps maybe some specific examples of recent additions to the portfolio.
Yeah, so I mean, I would maybe sort of frame this in sort of two parts in that question. So one is areas that have been working well and we're still feeling very good about the outlook there. And here I would put our digital infrastructure holdings and our electricity grid and energy storage companies. So what's the story here is that these are companies that make it's software and technology companies, and they are about making a sort of digital thread in how we design, manufacture, operate and maintain products across the life cycle. So applications like preventative maintenance, digital twins, all these sort of software-based applications. So that's one part. And then the other part is technology around AI, picks and shovels companies, electricity and infrastructure in data centers. So all this sort of group of companies has been working very well for us. And we're still feeling very positive for the prospects there. Very attractive business models, very sort of good growth outlook. And then, the other area that has been working well, I said, is about the grid and energy storage. So, if you think about data centers and what they mean for power demand, there's a massive incremental demand that is expected to come on board. And all these companies have targets to be 100% powered by clean energy. So, that is a tailwind for the renewable energy project developers. And also, there's a massive investment opportunity around electricity grids as we need to modernize the grids, make them cope with this changing electricity mix. I mean, for example, one of the sort of relatively recent, actually now it's about a year ago, additions to the trust is a company called Prismian that makes cables for the transmission and distribution of electricity. So again, sort of key part of that solutions puzzle. So these are areas that have been working well and we're still excited about them. And then I would say there are some parts of the trust that have been facing some headwinds, which we view as temporary. And we're sort of feeling that we're coming on the other side of that. I mean, maybe a good example is our exposure in bioprocessing. So, you might be sort of wondering how come you have bioprocessing companies, healthcare companies in an environmental markets fund. And, just to frame this here, these are companies that have products that really improve water and energy efficiency, power usage in different parts of sort of healthcare processes when it comes to making drugs. So, for example, we have a company in the trust called Repligen that is used in the manufacturing of drugs and vaccines, and really cuts down the water usage in these processes. So, pretty nuanced companies there, and they do offer something different in the trust, sort of diversification. Now they have been weak recently, and that's because we're coming out of COVID. Inevitably, all companies in the healthcare value chain built a lot of COVID revenues. So as these are coming off the sort of revenue base, they're creating some year-on-year difficult comparisons, and also a lot of destocking problems in these value chains. So we are, I would say, starting to leave that behind and sort of re-establishing a normalized growth for this market, especially as we look in 2025.
Excellent. Just one final question, if I may. So you talked obviously about the demands, kind of the power demands of things like AI, and one thing that companies seem to be reaching for as a source of lower emission energy is nuclear. Is that something that the trust would ever look at?
Yes. So nuclear energy, we have looked at it, over the years a few times. The last time we sort of reviewed it, our position was that nuclear is very positive in terms of its carbon footprint. So that's unambiguously positive. But then it has the waste issue. So, we sort of on balance took the decision at the time that nuclear is not part of the opportunity set. Now, since that time, there have been some sort of technology developments in this space, particularly sort of the small, the SMRs, the small molecule reactors, I think is the acronym. So, that has definitely, small modular reactors. So that has definitely changed things a little bit in terms of, the available technologies. But I would say there's still a bit of an information gap, because most of the SMR capacity that is actually out operating today is in countries like China and Russia, where we just don't have a lot of data around their profile when it comes to safety standards. How do they operate in real world conditions? So there's been a bit of a change. I think it's fair to say we are re-examining nuclear as a potential addition to the opportunity set. But when it comes to adding that in the trust, actually investing in it, I think there's still some pretty unattractive characteristics in nuclear. And that's sort of around, these are still very capital intensive projects, very long lead times. So I think, it's not the most obvious sort of investment for the trust. But yeah, it does have a role to play. And we would be monitoring, I guess, the investment opportunities as they come up in this space.
Thanks to Fotis Chatzimichalakis. That is everything from us this week. We've got one more podcast scheduled for this year, and Dan and I will be back next Friday to talk about all things money and markets, and we'll be joined by Schroders fund manager Jean Roche, and that episode should be live on the 20th of December. Until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.